delve deep into a topic often discussed but perhaps not wholly understood: hedging in forex trading. Whether you're a novice or an experienced trader, understanding hedging's intricacies can enhance your risk management arsenal. So what is hedging? At its core, hedging is akin to an insurance policy for traders. While it may not boost profits directly, it acts as a protective shield against unwanted market shifts. What are some key hedging strategies? A simple forex hedge. This strategy involves taking opposing positions in the same currency pair. For instance, if you're long on euro US dollar due to an anticipated rise in the euro, you could simultaneously go short on the same pair, mitigating risks if the euro unexpectedly drops. Multiple currencies hedging. It involves taking a position in one currency pair and then initiating an opposing position in another correlated pair. For example, being long on euro US dollar and short on dollar Swiss, given their historical negative correlation. Diving into an example, let's assume as a trader you anticipate that the European Central Bank, or the ECB, is going to increase interest rates. This belief drives you to go long on euro US dollar, expecting the euro to strengthen against the dollar. However, there's a catch. The US Federal Reserve is having its meeting a week after the ECB. Rumours hint at a potential interest rate hike too, which could strengthen the US dollar. In such scenario, hedging becomes crucial. To hedge your position, you can directly hedge. You could simultaneously go short on euro US dollar. If the euro falls, the losses from your long position will be offset by gains from your short position. Correlated hedge. Considering the negative correlation between euro US dollar and dollar Swiss, you might choose to go short on dollar Swiss if the dollar strengthens or the euro weakens. The dollar Swiss short position could compensate for losses in the euro US dollar long position. Now let's say the ECB does raise its interest rates and the euro strengthens. Your long position in euro US dollar proves profitable. The subsequent week, the US Federal Reserve surprises everyone by holding rates steady. The dollar doesn't gain strength as expected, and the euro doesn't decline significantly. In this situation, your hedging strategy has paid off. Your long position on euro dollar has made profits, and the hedge position, while possibly not as profitable, has offered protection against potential adverse movements. Now, there are factors to consider. The cost. There are costs associated with hedging, including the spread and the potential overnight fees. Always weigh the cost against potential risk mitigation. The market dynamics. Currency correlations can change. It's essential to frequently reevaluate your hedging strategy in line with market dynamics. To conclude, hedging is not about maximizing profits. It's about preserving capital. Like any tool, its effectiveness hinges on how adeptly it's wielded. As market conditions evolve, so should your hedging strategies. Thanks for watching this video update. I really hope you enjoyed it. If you did, leave it a thumbs up. Subscribe to the YouTube channel to see some more of our forex trading content. And I'll speak to you in the next video.